All right. So Martin Tobias is the founder of Incisive Ventures. He's ex-Accenture, Microsoft, and a former venture partner at Ignition Partners. Martin is a three times venture funded CEO and has raised over $500 million as CEO with two IPOs and has also invested in over 200 companies as an angel, 75 through Incisive Ventures, and is also a limited partner in over a dozen VC funds. Martin was an early investor in Google, DocuSign, OpenSea, and over a dozen other unicorns. He is the father of three daughters, a cyclist, surfer, poker player, and a student of Stoicism. Sounds like a pretty good life, Martin. How are you?
Hi, thanks for having me. It has been a good life so far, and I'm really excited to continue to be engaged in entrepreneurship as a VC. I think my time being a CEO is over. I
Hmm.
really don't want to work that hard anymore, but I love helping other people work very hard.
Are you saying that it's easier to be an investor than a CEO?
It's certainly easier to be an investor than a CEO. I mean, I've been in the CEO seat 3 or 4 times, and that's a
Hmm.
70, 80 hour a week job. And you're
Yeah.
responsible for people's, food that they bring home, not just the
Hmm.
investors, the employees. It's quite a lot of responsibility that I take very seriously. I take my responsibility as an investor very seriously too, but at the end of the day, you're kind of a co pilot and a
Hmm.
partner to the CEO, and the responsibility of the operations are not on our shoulders. Sometimes the responsibility of like follow on financing and business development is, but
Yeah.
that's a little more manageable. Also, I made the decision about 3 years ago to have a little bit more work life balance, and I'm working now 40 hours a week as an investor, and for me that's half time.
Hmm. Do you think that your career path that you've taken is pretty common that you've seen to your friends? Like, what do you recommend to people? Do you think it's like, hey, I work really hard, CEO, and then, transition? Or do you find that some people, it's just like they can kind of grind it out forever indefinitely? What do you kind of see amongst your peers? And also, what do you recommend?
um, I recommend that people every couple years, maybe every 5 years, basically take serious stock with of their lives and what they want to do for the next what they want their life to look at like 5 years from now.
Yeah.
When I was, CEO of a pumping company that went public, I had 450 employees working 80
Hmm.
hours a week. I thought, what do I want to do in 5 years? And I said, I did not want to be doing that. I did not want to be working 80 hours a week with 500
Yeah.
employees. So then you sort of can make a path, and I think everybody will end up with a different path. For some people it might be starting another company. For
Yeah.
example, I love the early part of being a CEO, the sub 50 person company. I did
Hmm.
not like being a CEO of a 500 person company. It's just too
Mm.
many people to manage. So
Yeah.
I, at that time, decided to go leave and start another company as opposed to being an investor. I think some people go the investor route. I don't know the numbers. I would guess it's a minority
Hmm.
that go from CEO to investor route. I would say the vast majority go from CEO to golf, or
Board member, maybe?
some form of retirement,
Yeah.
um, because being a professional investor like I am is not retirement. It's still a
Yeah.
job and responsibility, because you've got responsibilities to your limited partners, to your CEOs, and things like that. So it's a higher level of engagement than many people want to do. But frankly, it's what I want to do, and it's turned out to be my path because I suck at golf. And you
I
know,
think a lot of people are pretty bad at golf, to be
I
honest.
just can't sit down. I have retired,
Yeah.
4 times in my life, basically
Hmm.
taken 2 years off. And, I'm no good at it. I'm no good
Hmm.
at doing nothing.
Yeah.
Even when I had a young kid, my first daughter, I took Loudeye public, the last company to go public in the dot-com boom. And I
Hmm.
took 2 years off with my 1 year old. And I loved hanging out with my family, but after a year, I knew every word of every Teletubbies song, and I hadn't had an adult conversation. I mean,
Yeah.
I was literally going crazy. So I think it gets back to, you need to really do a pretty deep analysis of what you need to be a happy and engaged person. Some people need 80 hours a week. Some people need, lots of free time and travel
Yeah.
with their spouse or their family. For me, I need at least 30, 40 hours a week of hard business type problems to solve, in
Hmm.
addition to lots of time with my family. And that for me meant that being an investor was the perfect path. And I can see myself doing this, forever. There's no, in my mind, no retirement where like you reach
Yeah.
the end of the goal and then you just basically do nothing for the rest of your life. I like to do all the things
Yeah.
I want to do at retirement, like now.
Yeah.
I want to go surf. I want to go ride my bike with my friends. I want to have, flexibility in my schedule. I do everything that some people want to do in retirement, right now.
Yeah, no, I really like that approach. And I think that balance is key. And one of the reasons why I was so excited to talk to you was that you've had this 25-year career. And, I think that a lot of people sort of don't think about into the future. They don't think 5 years into the future. They don't think 10 years into the future. And I almost feel like, if you can kind of set up a balance right now, it allows you to never have to retire and you can kind of just keep working. And, if money is your goal, you could probably make a hell of a lot more working 30 hours a week on something you love for the next 30 years than working really hard for 5 or 10 years than being burnt out and quote unquote retiring for 20 years, right?
No, yeah, exactly. And I learned that the hard way. I mean, I did that. I mean, I I burnt out a little bit and had to find a new balance. One
Yeah.
of the things that I have really enjoyed, over 25 years, I've been both an operator and an investor going back and forth. I've invested for 25 years and I've been an operator and venture funded operator 3 times. I like both roles, but I've also done it through multiple cycles. We Loudeye was the absolute last company to go public in the dot-com boom. We went public
Yeah.
in March 17th of 2000. The peak was March 21st. So we were, and I
I love
always
how you
say,
still remember the date.
of course. Well, I mean, if I had been 5 days later, we would not have been a public company.
Wow.
And what I say about bubbles is it's better to be inside of them than after when they
Yeah.
burst. Um, uh, but I was in the running a company called Imperium Renewables in the 2008 crash, and
Hmm.
with that company, we did not make the IPO window. The IPO window closed before we were able to get it public. I was, investing through the 2020 crash, and it's actually pretty interesting to have seen the cycles in both the public and private markets that happen, because then as an investor, you have a much better perspective as to what cycle you're in, how long it's going to take for these to recover, what it takes to, last through a down cycle and things like that. And I'm a little concerned by some investors that I see who have started their careers maybe in the last 10 years. In November of last year, we basically ended a 12-year bull run in venture
Yeah.
capital. And if you had only been investing during the bull times, your ideas of how things work in the venture ecosystem are very different than if you have been through crashes before. So I am personally happy that I went through crashes
Yeah.
because I think it makes me a better investor and mentor to CEOs now, especially young CEOs who may have started, just in the last 4 or 5 years. They probably never saw a bust
Yeah.
happen.
What's the one sort of big takeaway that you have from those crashes that you sort of keep in mind going forward?
Um, well, I mean, there's a couple. Always raise more money than you think,
Okay.
and focus on what's in your control, not outside your control. Um, you know, uh, for example, when I took Loudeye public, we had $120 million of cash, and the stock
Hmm.
market crashed around us. Um, what we did is said, okay, we need a much lower burn rate. Despite having money in the bank, we could have burnt money uh, more right then. But we're like, we have to control what we can control, which is our spend. We cannot control the fact that the stock market crashed around us, that customers are all running away. We can't control the outside environment. We can only control our inside environment and what you do. And I think the best CEOs do that. I mean, you saw the memos going out, last year from
Yep.
VCs saying, the environment's changing, switch your thing from growth at any cost to growth at a reasonable cost.
Hmm.
Control what you can and only respond, but take advantage. If you're in a bubble, if you're in a hype cycle, take advantage of it. I talked to a founder like 3 weeks ago, and he said, I only want to raise $500,000 at five. I don't
Mm-hmm.
want to sell more than 10% of the company. And I said, first of all, I think that's not enough money. Second of all, you have demand for about $1.5 million. I
Yeah.
think you should raise as much money as you can. Well, I'm worried about dilution. And I'm like, you know, you know, 90% of something, 70% of something is better than 90% of nothing.
Yeah.
Um, and the number one risk in today's environment is follow-on financing and your
Mm-hmm.
ability to convince people to continue to give you money. In a free money environment, which we just exited, people could raise every 6 months. Right now, it's hard to raise every 12 or 18 months. So, I encourage people to be less valuation sensitive and more, runway optimizing.
Yeah, no, I like that advice, and I definitely I'm ready to dig into your investing career thoughts and
Yeah.
insights. Before we dig into that, I do want to give the audience a quick background. And so, you mentioned that you've done 200 angel investments, 75, an additional 75 through Incisive. What's your sort of day to day? Are you still making angel investments these days, or is it all from your fund now?
No, I'm not. I'm not doing direct angel investments. I'm all direct investing from the fund. I'm on my second fund, which is a $10 million pre-seed fund, and
Cool.
we write 150 to $400,000 checks into pre-seed, which I define as having an MVP in the market for at least 3 months of some initial revenue traction. Companies raising 500 to $1.5 million dollars.
Very cool. And what type of startups do you look for in, I guess, pre-seed?
Well, one of the things I did when the pandemic started was that I sat and looked at all those 200 companies I have ever invested in, all the
Hmm.
LP interests I had in venture capitalists. And one of the things I noticed is that as a direct investor, I was performing about a 6.8x TVPI versus my LP interests, which were about a 2.6x. So I'm
Hmm.
like, I'm about three times better direct investor than through
Yeah.
VCs. So maybe I should do that. And then I looked and said, okay, which ones was I really good at? And
Hmm.
where did I get lucky? So I said, I've been in over a dozen unicorns. Frankly, half of them, I just got lucky and I didn't
Yeah.
really know anything. And if you're looking at creating an investment thesis, you can't plan on replicating luck, but you can plan
Hmm.
on replicating a thesis. So the ones where I had a particular opinion that turned out to be right, that was counterintuitive at the time, I tried to replicate those. And a perfect example, and so my thesis is software that reduces friction at scale. And a perfect example of that is DocuSign. So
Hmm.
DocuSign, you can sign something on your phone instead of a fax machine. There's millions of signatures a day. There's the scale. The technology is really, making people's lives better in a material way. That's something that happens millions of times a day. Frankly, that was a hard company to get funded in the beginning because people thought this looks like a feature, not a company.
Hmm.
Adobe could copy it in 5 seconds, but they were able to put workflow around it, the signing order, and all of this stuff, integrate with document management systems, and turn it into a platform. And that was my bet. I said, I bet they can turn it into a platform and it's not just a feature. That was a counterintuitive bet. Not many people believed it, but it turned out to be correct. And that's how Ignition made like 400 times their money on
Yeah.
DocuSign. So I keep looking for companies that are like that sound like
Hmm.
bullshit, but if they work, they change everything.
Yeah. I mean, I always tell people I feel like a lot of the best startups, that sort of end up with the best exit, like at one time they sounded like terrible ideas,
Yeah,
right?
I mean, look
Because
at
otherwise they would have already been done. They would have already been invested.
you've heard that many times. Paul, Graham talks about Airbnb. People sleeping on your
Right.
couch. Are you fucking kidding me? Uber. Are people going to like
Stranger
drive
picks
their
you up.
cars around? But how big was the rideshare market before Uber? It was zero. They created
Yeah.
demand that was never existing before you had the technology. And that's
Right.
another aspect that I look for is somebody that could potentially create a blue ocean. And there's people that have done that very successfully in fintech. Take a company
Hmm.
like Brex. They underwrote small businesses using a different underwriting criteria that the other credit card companies weren't doing. They got a ton of customers that never existed before. I invested in a company doing something similar in Latin America called Jeeves, which is another credit card company. But that's another thing, using technology to expand product access to a group of customers that have never had it before. that is a great model that consistently works.
Yeah. So if I was a founder today, I feel like one of the things that I would really value about, having you as a potential investor, would be your 25 years of experience, kind of having taken public companies. And I feel like especially in this market, where it's tough,
Yep.
much tougher, to start, to get funding, to do follow-on funding. So what are you sort of telling today's founders, what are you sort of educating them on? What's like the number one thing, either a mistake they're making or something that it's like, hey, here's where I can just give you great insight and help a ton.
Well, it depends very much on the stage.
Hmm.
But
Well, let's go pre-seed since that's your specialty.
Pre-seed, you basically only have to do two things in pre-seed. You have to
Hmm.
get enough product market fit to attract the next round of investors, and then you have to raise that next round. You're almost never
Hmm.
creating a profitable company in pre-seed. So
Right.
you don't really, you hope that you have most of the team there. Hopefully you have a business founder, a technical co-founder. Hopefully it's not a lot of hiring and business development. It's getting the product market fit correct,
Hmm.
and start to get the market to pull your product through. So that's really the job at pre-seed. And if you do that well enough into sort of the top 10% of companies in your category, the seed and Series A investors will write you a follow-on check. But the number one thing, which mistake I see most pre-seed CEOs make, is to just raise money and to tell people, like, you say, what's your use of proceeds? Well, I'm going to hire some people and I'm going to, write some code. What you need to do in pre-seed is you need to know the traction metrics that the seed or the Series A investors want to see in order to
Hmm.
write that check for you. And you need to put a plan together to raise enough money to achieve those objectives. Most pre-seed CEOs do not do that. They're just wanting to get money to do whatever the hell they want to do without a real
Hmm.
view of how far they have to get. That's why you see so many pre-seed companies doing pre-seed plus, pre-seed extensions, bridge
Hmm.
rounds. It's because they misraised, or they did a hand-to-mouth raise, just getting
Hmm.
safes from their pals as soon as they can, but they never got enough money to complete a unit of work that is going to be your next valuation milestone. So that's the number
Hmm.
one problem I see most pre-seed CEOs doing, is not building a financing round to fund a specific set of KPIs that have a high degree of confidence that are going to unlock the next funding round.
Got it. So what would you tell those pre-seed founders, to start talking to, I guess, seed investors early and so that
Yes,
they
I tell
understand, like, how do you know what those KPIs
talk
and
talk to
metrics that you
talk
should
to
be
seed
targeting?
and Series A founder, talk
Hmm.
to seed and Series A VCs. They're going to tell you
Hmm.
no, but if you're
Hmm.
lucky, they will tell you exactly what
Hmm.
would be a yes. So, for example, I just did that with this company called Tangibly.
Hmm.
Tangibly went and pitched, it's a legal tech company doing
Yeah.
vertical market software for trade secrets. They pitched a partner at Madrona, and Madrona is a big
Hmm.
multi stage fund. They said, we like your category, we like you, you're too early. They sent them to me, but they told me, um, I like this guy if they do X, Y, and Z, and they gave me three KPIs. We would be interested in leading the seed. So I talked to the CEO. We redid his plan. Rather than his plan being what he wanted to do, we said, what's the plan
Got
to achieve those three things that Madrona told you they want to achieve? That's a slightly different plan, right?
it. Hmm.
So we put that plan together. We raised. I led the pre-seed. We raised $750,000. The company a year later overachieved their plan. Went back to Madrona, gave them the update. Madrona gave them a term sheet. They just raised $7 million in a seed round, but they
Very
were
cool.
shooting for a goalpost that they knew.
Hmm. What KPIs specifically would this be? Sort of, month over month growth, revenue? What kind of what are the sort of most common three KPIs that you would look to, and like what would be? I don't know. It might be different for every company,
It's
but
different for every
what's like a
company,
real
but
life
typically
example?
for a B2B software company, it would
Hmm.
be ARR, month over month MRR growth, um, a certain scale of customer breadth, typically,
Hmm.
10 or more
Mm.
enterprise customers, and also a couple of KPIs around customer retention and hopefully, net revenue retention. So
Yeah.
basically, are you able to land and expand? Do pilots convert to paid users? Do paid users buy more seats? Because that's
Got it.
really, what the Series A guys are looking for is, can I pour gas on this thing
Yeah.
that's working, to really, kick it in the butt? You have to show enough customer engagement and enough, net revenue retention to tell a convincing story, that get more money will get higher revenues.
Gotcha. Yeah. No, I like that. And I think definitely, uh, I feel like I might also take that one step further and maybe talk to two or three seed VCs and kind of get their positions, and then maybe
Well,
triangulate from there. I don't know if
exactly.
I want to put all my eggs in one basket, but
But the interesting exercise there is every CEO says, I want to execute like this. And rarely, it goes back to my self-awareness thing that I do for myself. Rarely do they say, is that the right path? Am I going to the right place? Right. But if
Mhm.
you talk to two or three later stage guys, they tell you what they want to see. You might change your plan, and you're going to have a much, so for example, you're going to have a much higher degree of success raising follow-on financing if you are shooting for something that people are interested in. The average pre-seed company, if you look at PitchBook, only
Mhm.
30% of them raise follow-on financing. 70% of
Yeah.
pre-seed companies fail to raise follow-on financing, and they fail. In my portfolio, 74% of my pre-seed investments have raised follow-on financing. So that's 2.5 times better than the average pre-seed funded
Yeah.
company. I think in part I'm better at picking good teams, but this process of thinking about sizing the pre-seed round to achieve a known set of KPIs, which have a high degree of
Yeah.
confidence of getting follow-on financing, is another key aspect in being able to attract that follow-on financing, because you're executing a plan which has a high confidence set of goals instead of
Yeah.
just whatever the fuck you feel like doing, which frankly
Yeah.
you
I
see
really.
many people doing.
Yeah, no, I really like that stat that you shared because I think it sort of makes founders think about, obviously they're always, especially if they're a hot company or if it's in, more of a bull market, they might have their more choice, when it comes to investors. And, obviously there's sort of the name brand, it's like who actually you can kind of, you know, go ask, and I guess it's more subjective, like, hey, is this person a great investor? And it's like, yeah, that's my best friend, he's a great investor. But you're sort of bringing that plus your experience, which is kind of more the qualitative stuff. Now you have this quantitative data point of follow-on funding, which to me, I never really thought about it that way, but that seems like a huge KPI, for success. Are there any other KPIs like that or anything else you think about?
That's the main one.
Yeah.
Of the 65 companies that I invested in the last 3 years, they have raised a combined over $2.5 billion of follow-on financing. And that's another KPI pre-seed investors track, is how much has their portfolio raised over time.
Yeah.
That's pretty high. Um,
Yeah, I definitely like that one. I mean, I guess though that could easily be, not. I mean, the sort of absolute amount isn't as important, I guess, as the percent of
I
companies
think
compared to average,
the
right?
percent of companies is much more indicative, because
Yeah.
that's the number one job in pre-seed. You have to get that next
Hmm.
round done. And
Yeah.
I am surprised how few pre-seed, and specifically angels. I mean, the angels are the worst at this. Angels are like, they meet.
Well, that's why we're here on this podcast,
I
Mark.
know, but well, so here's something I would encourage angels to do. I would say, think about who's going to mark up your deal. And
Hmm.
because most angels, and I started when I was an angel doing this, I'm like, I meet a guy, seems interesting, seems like he's building something interesting. Great. Here's $25,000. Here's
Yeah.
$50,000. You might as well be flushing that shit down the toilet. If you don't have any connection or understanding to who's going to write the next check, or what
Mm-hmm.
other companies are building in that space. Maybe there's 100 companies building something similar. How much total money has the company raised? How much runway do they
Yeah.
have? Can they achieve? Sometimes a $25,000 check, you're giving a company, 1 month of runway. Like, what is the
Yeah.
company really going to do with that money? Unless you give the company, or a part of a round that gives the company enough runway to achieve something important, that's the number one reason companies fail. They don't raise enough money to achieve enough to get more money. And angels, in particular, fall into that trap because a lot of these rounds are hand to mouth, rolling closes, just writing checks whenever you can. And that's incredibly risky strategy because the company can never have enough money to achieve enough milestones to get validated in the market. I mean, it's a very risky way to do it.
Yeah, well, I guess this is good timing because I am on the verge of writing a 25K check right now into a company and a founder that I just met. Really like the team, really like the product, and they're sort of in a situation where they've got maybe three, four, $500,000 that they've kind of got soft circled, and then a couple potential leads in the pre-seed side that they're talking to. So, what would you advise? Haven't said yes yet, but I've got an email drafted that's basically a yes. What would you advise someone like me in that situation? Like, I've asked some questions, but what would you be looking for when it comes to especially like that follow-on funding and
Well,
sort of the.
I would do some diligence to see if that, funding is real. I
Hmm.
can't tell you how many CEOs have told me, XYZ VC is interested. I call them and they say, no, I passed. So,
Hmm.
it is not beyond CEOs to overstate investor interest. And you don't want to
Yeah.
be the one investor who wires when the other investors don't. So I would
Hmm.
do some diligence on that. I would also want,
So would you say that in this situation, I should only invest if there's going to be, if they get a lead for this to come in? How do you handle that?
well,
Especially because I think that's where it's tough with the
it,
25K
it
checks, right? If you are the lead at the pre-seed, it's a lot easier because you kind of have that conviction and you're, driving most of it. Whereas with me, you could imagine for a founder, they don't love someone like me saying, "Hey, I'll invest if, you get a lead," right?
well,
Once they get a
exactly. If
lead,
you're a
then it
small
kind of wins
check like
themselves.
that, it's hard to say you'll invest. If personally, as an angel, I don't write any more idea stage angel checks into sort of sub
Hmm.
$500,000 rounds where it's 20 guys at $25,000. I just don't do it because there's even higher than higher than 70% failure rate of those companies. If so, if I were you, and you wanted to participate in a real pre-seed, I would say to them, yes, I will participate, but you need a lead. And I
Hmm.
would not, as an angel, want to participate in an underfunded round. Now,
Yeah.
they're not going to really like that. But if I were to invest prior to the pre-seed, I would want some huge premium. I would want like
Yeah.
50% or 30% of the potential follow on round price, which is also hard to do. Frankly, I would recommend that angels get in alongside institutional investors in the pre-seed, and you can tell them why they should get you in, because maybe it's a $700,000 round and the professional investors are taking 600 of it.
Hmm.
CEOs should take 4 or 5 high value angels for those small checks because they're going to get a lot of value out of those people. And you need to present yourself as an angel as one of those people that can add value, which is why they should let you in,
Yeah.
as opposed to taking that extra 100 from another institutional guy. I recommend to CEOs, even where I am an institutional investor, I'm like, take at least 30% of the round and give it to the highest value angels you can find,
Yeah.
because for them that's a material amount of money, and they're going to do a lot of
They're gonna work their ass off, right?
work
Like
their
me.
ass off, maybe even harder than a fund will.
Yeah.
So I encourage CEOs in pre-seed to make room for angels, and I encourage angels to do it in pre-seed because then you're participating in a fairly fully funded round. Personally, I would never, as an angel, do any of these. I don't care how much I like them, hand to mouth, 25K safes every, couple weeks type rounds. I just would
Yeah.
not do those.
Cool. Well, that's good advice and very timely for me. So appreciate that, Martin. And I really appreciate you sharing all your experience. Before we let you go, I do have a couple trending Twitter threads that I want to get your take on because I know you are active on Twitter, right?
Yes.
All right, let's do it. So I'm going to share this first one here on the screen. It is, and I'll read it off from Koki Hasiotis. And let's see, she is building something new and investing. She says, apparently VCs are suggesting that for seed rounds and extensions, founders need to be generating $750,000 to $1 million in revenue to not take a flat or down round. True or false? What do you think, Martin?
Well, it depends on what the original price of the seed round was.
Hmm.
I don't know. I think those numbers are a little bit high. I am seeing seed rounds happen from professional VCs at about a $500,000 ARR run rate. So having 750 or a million, it would be a seed plus or sort of
Yeah.
a more advanced seed.
Hmm.
But valuations in the seed are like around 15 million. They're definitely down from last year where they were on averaging around 25. So I don't know what in her thread what the original
Yeah.
valuation was, but valuations at seed are down about 50%, and traction metrics are up about 100%. So in order to have a flat round, yeah, you've got to have about double the revenue ARR that people would expected to get the same valuation that you would have last year.
Yeah, definitely. So time to make money, huh?
Yes.
All right, cool. I'll go ahead and share the next one. And it is from Darren Marble right here. Pull it up on the screen. Darren's, oh, actually,
Oh, I know, Darren. Yeah.
yeah, we'll actually, no, that was the backup. I'm gonna switch.
Okay.
I'm gonna do mine. Marc Randolph, who co-founder of Netflix. So, some people know him. He says most VCs won't say no outright. They won't say yes either. They'll want to gather more data, evaluate your progress, and see how the space evolves. So if they're not tripping over themselves to follow up with you, it usually means they just aren't that into you. It may sound harsh, but that's the way it works. What do you think?
100%.
Yeah, I feel like, I make a lot of intros to investors for founders that I work with, and they're always, kind of bugging me, what'd they say, what'd they think? And I'm like, this probably isn't good if they're not, replying to you yet. So
Yeah. I
maybe
mean,
break it to you.
I receive about 300 companies a month. I take about 60 meetings. So I say no
Hmm.
without, right away to 240 of them. Um, Out of those 60 meetings, I say no to 55 of them and start diligence on 5 of them. But I tell people in
Hmm.
the meeting yes or no. And that's frankly unusual. What he's talking about is more usual, which is people will say, this sounds interesting, da 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 da. But
Yeah,
if a VC doesn't say, I'm starting diligence. I'm going to
yeah,
dig in. I'm sending you a list of information that I want to see, financial, customer
gotcha.
references. If they don't engage like that, it's a no.
Hmm. Got it. Have you ever sort of, been added to an investor update or, sort of tracked a company for months or years at a time and then invested later in a company that you initially passed on?
Yes, of course I have. One
Mm,
thing that I do not necessarily like is CEOs who add me to their investor updates after I said no and did not
mm,
ask for the investor updates. If I ask for the investor updates, I mean, there are times where the stage or timing is just not right, and I really do want to follow on, and I ask for investor
yeah.
updates. If I ask for updates, please send me updates. If I do not ask for updates,
Hmm.
please do not send me updates.
Got it. I guess you may not like that, but if I'm a founder, do you think there's a downside? I add you to investor
There's no
updates, you don't love
downside
it, but
for you.
in 6 months, it's like, oh my God, we have meteoric traction, and
There's
you're
no
like, oh
downside,
shit,
and I
this
see
company.
more founders doing it. It's not a big enough red flag to make me not want
Yeah.
to invest in your company. It's just slightly annoying.
Yeah, I think that's a good way to put it. So, cool. Well, I appreciate all of your insights and input. If people want to pitch you, if people sounds like you have an input forum on your website, or where should they go to follow you, find you, and pitch you
Yeah,
if they're a founder?
they should follow me. I'm mostly active on Twitter. It's Martin G. Tobias, and I have a link in my bio, which is a bit.ly link, and you can pitch me
Cool.
there. It's an Airtable. I much prefer that versus email because I have some scoring and ranking algorithms and workflow stuff that helps me
Nice.
automate getting meetings and reviewing decks and things like that. So I would, but that's also linked on my website, which is incisive.vc, where you can read my blog and read about my thesis. The reason I'm very active on Twitter and my blog is that, founders and CEO and VCs are in this low probability matching game. I say no 99% of the time. They hear no 99% of the time. What can help a low probability matching game? If each people communicates more about what they like, what stage, what verticals, things like that. I have 7 meta themes that I like to invest in. I publish them on my blog. Read those. If you don't fit in those, it's unlikely that I will be interested in investing in your company. Doesn't mean your company's no good. It just means that I'm not the right investor
Yeah.
for you.
Very cool. Well, we will link up to all that information in the show notes, and people can take a look, follow you on Twitter for all of your great insights, and appreciate you coming on,
All
Martin.
right. Thank you. It's been fun.
All right, take care.